In February 1985, a 26-year-old in Mumbai launched a small finance shop out of a 300-square-foot office. By the time he stepped down 4 decades later, he had built an institution with total assets exceeding 6.9 lakh crore rupees. The wealth generated in that window is staggering. A single lakh invested in the firm in 1986 would be worth over 2,000 crore today, one of the most extreme examples of long-run compounding in the history of the Indian stock market. This transformation from a tiny bill discounting startup into India's fourth-largest private bank is now a standard case study in disciplined growth. The bank reached this scale through a methodical cycle, exploiting small structural gaps in the market, reinvesting every rupee of profit, and expanding through joint ventures that eventually became wholly owned subsidiaries. To understand how it started, you have to look at the mid-1980s, when India's banking system was a rigid, state-run monopoly. It was almost impossible for a new player to break in. This chart shows the inefficiency of that era. State banks lent to companies at nearly 18%, while paying depositors barely 6%. That massive spread created a vacuum for any nimble player who could provide cheaper credit. Uday Kotak recognized this gap. He left his family's textile trade to launch Kotak Capital Management Finance with 30 lakh rupees from friends and family. Since 30 lakh wasn't enough to start a bank, Kotak focused on a high turnover strategy, operating outside traditional banking regulations of the time. This flowchart shows his first entry point, bill discounting. Kotak would buy trade invoices from companies at a discount, providing them instant working capital more cheaply than a bank could, then collecting the full face value later. The profitable business needed a name to build institutional trust. In 1986, the group partnered with the Mahindra family, gaining credibility to scale its lending. When India began liberalizing its economy in the 1990s, the firm used its growing reputation to bring in global expertise. Kotak traded minority stakes for international branding and technical skill, partnering with Goldman Sachs, Ford Credit, and Old Mutual. But as each business matured, he bought out the foreign partners, turning them into wholly owned subsidiaries. This strategy allowed a small finance firm to assemble a world-class financial supermarket while capturing the full profit of every division it had built. By 2001, the central bank opened a new regulatory path that allowed well-run finance companies to apply for formal banking licenses. Kotak was the first to move. In 2003, Kotak Mahindra Finance became the first non-bank player in India's history to convert into a commercial bank. This transition changed the economics of the entire group. Instead of borrowing from other banks at expensive wholesale rates, Kotak could now gather its own low-cost deposits from the public, instantly widening profit margins across every loan book it owned. This license turned a collection of finance businesses into a high-margin lending engine that could finally compete with the giants of Indian banking. To gain national scale, Kotak targeted geographic gaps. In 2015, the bank merged with ING Vysya, instantly gaining a massive retail footprint in southern India. As it grew, the bank entered a bruising 6-year battle with the Reserve Bank of India over who should control an institution this size. The regulator demanded that Uday Kotak dilute his ownership stake, arguing that a bank holding public deposits should not be dominated by a single individual. In 2018, Kotak attempted to meet the rule by issuing non-voting preference shares. This reduced his economic ownership on paper, but because those shares had no voting rights, his actual control over the bank was unchanged. The move triggered a court battle that ended in 2020 with a unique settlement. Kotak was allowed to keep a 26% stake, unusually high for a bank promoter, in exchange for capping his voting rights. The settlement proved the founder viewed individual control as a strategic asset worth protecting, even at the cost of a public fight with the regulator. By the early 2020s, the institution had reached over 114,000 employees, with a highly successful digital banking platform. But the bank's identity remained deeply tied to the judgment of its founder, who had led the group for nearly 4 decades. That era ended in late 2023. Uday Kotak resigned early, handing the reins to Ashok Vaswani, the first outsider to lead the bank. The transition was immediately tested. Months later, the RBI banned the bank from onboarding new digital customers and issuing credit cards, citing major IT governance failures that had built up over the previous years. Although the bank fixed the IT issues and saw the ban lifted in 2025, the recovery was met with another shock. Vaswani announced he would step down in 2026 for personal reasons. Kotak Mahindra's history shows that a disciplined strategy can build a financial empire from 30 lakh rupees. But as it enters its second leadership search in 3 years, the bank must now prove that its engine can continue to compound without its original architect.